Okay, so I'm going to get started. Good afternoon, everybody, and welcome to the financial planning webinar for staff in Beaumont Hospital. So, firstly, my name is Neil White. I'm Senior Financial Planner and Area Manager with Irish Pensions and Finance. So, I look after the Beaumont Hospital, and here together today is Keith Waters. You'd recognise him, he's one of our Senior Financial Planners, and then Molly Byrne as well, who's one of our Financial Planners with Irish Pensions and Finance. So the purpose of the meeting today really, sorry, we have another person coming through there. So before we get started on the agenda of what we'll cover today, I just wanted to give everybody an idea of who we are and then also what we do for our clients. So I suppose Irish Pensions and Finance, we were established in 1993. We've over 24,000 policy holders currently. We have 3,500 retired clients. And we have over 600 million in funds under management. We have authorised advisors, so we're not tied to any one company. And we have a team of nearly 30 qualified financial advisors and experienced back office staff. But how you may know us or recognise is we administer one of the group additional voluntary contribution schemes, or AVC'S, in Beaumont Hospital and across the public sector, including in Garda Síochána of the various different councils. So I suppose your pension scheme will be our primary area of expertise. But not just that, we also are financial planners, so we'll look at your other areas of financial planning, like your savings, investments, life cover, etc. So what do we do for our clients? So what we do for our clients, we help them to put a financial plan in place. So financial plans, it's all about really understanding what your objective is. So if what's your objective around your retirement, what type of retirement you would have, what you would like to see happen if something was to happen to you before retirement, and then also how you'd like to maybe meet your savings objectives or goals, like changing the car, purchasing a new property, things like that. So some questions that public sector staff will ask themselves before they meet with us is, will I be short in service? Is that going to have an impact? Would I like to retire early? I think everybody would like to retire early. I don't think that's something that can go without saying. And then will you need to fund for a gap, depending on the scheme you're in, and we'll touch into that a little bit later in the presentation. Is that something you need to consider? And then also touches into savings and investments. Are you making the most of your savings, or potentially are you able to get better returns for your savings in the future by utilising the likes of an AVC for tax relief? And then, as I mentioned previously, do you have sufficient benefits in place based on your main scheme that will cover you in the event that you got sick or passed away? Because at the end of the day, from your employer, you do have a lot of benefits, but it's about understanding whether or not they will meet the needs or requirements that you have. And as we always say, if it's not broke, don't fix it. But unless we can have a look at it, we're not going to be able to establish that. So look, the agenda for today, okay, is we are going to focus on the pension, on your main scheme benefits and how that works and things to consider. The talk today is really just to give everybody here a bit of food for thought of things to consider, and whether or not it makes sense to sit down and look at your own financial plan. And then what will cover your main scheme benefits, so what they are, then what your other options are to supplement them benefits if you want to retire early, like I said, or concerned about service, and to utilise how to use the AVCs. What your options are at retirement then, so how do AVCs work? That's important if you're an existing client, but also if you maybe have an AVC from a previous employment, current employment with another provider, or past pensions. And then we'll touch on the other areas of financial planning, so what we cover in our consultations and can give you advice on. So look, the purpose of today is, it's very much to give you the information, conscious that everyone is on their lunch break, so we'll hopefully get through things quite quickly. But what I would say to you is take some notes, have some questions, and when one of the advisors follows up with you from the presentation, we'll be able to cover it at that stage. Okay, so what benefits are payable under your superannuation scheme? Okay, so currently there's 5 main benefits, and that's applicable to the various different superannuation schemes. So there's currently 4 different strands of the public sector pension scheme. So there's the pre-95, the 95 to 2004 entrants, 2004 to 2013, and then the post-13 entrants. So your pension benefits and your other benefits, like your lump sum, your illness benefit, or debt and service, will all be relative to those dates. So they're really important to know. So your pension. So depending on the years of service that you have, and your final salary will determine the pension that you'll have. And the lump sum that you have will be determined by the years of service that you have and the final salary in 3 out of those 4. Now, the only one that isn't based on your final salary is the post-2013. And I'm going to touch a bit on that as we go through this. So in essence, when it comes to your pension and your lump sum, the rule is the more service you have, the more pension you will get. It'd be fantastic if it was the less service I had, the more pension I got. But unfortunately, it's the more service you have, the more pension you receive. So the magic number for years of service in receipt of the full pension for anyone that joined before 2013 is going to be 40 years. So if you receive 40 years or do 40 years of service, you receive a full entitlement to your pension. And there's some things to consider depending on the bracket that you're in, and we'll touch on those as well. Now, the illness benefit that you'll have from your employer, they will provide sick pay. And that, typically speaking, is 3 months full pay and 3 months half pay. And that's, again, typically on a 4-year rolling period. But just a caveat, that can vary depending on the scheme that you're in and when you joined and the service that you have. Then there'll be a debt and service payment. So there'll be a lump sum payable in the event that you were to pass away in service. And that, again, depends on when you joined. So that will vary from 1-time salary up to 2-time salary on the newer scheme. But again, it will depend on when you joined. And then the spouse and children scheme. So this is applicable to the majority of entrants. I think it's anybody that joined after 1986 is automatically entered into this scheme. And again, that will be determined by the amount of service that you have and the salary that you have. And then obviously, if you're married, and how many children you have. Okay. Now, a couple of things to consider on the pension. As I mentioned previously, it will be determined by the amount of service that you have. So if you, for example, joined later, you're not going to potentially have the full service. Or if you've reduced hours, job shared, that's obviously going to impact on the amount of service that you have when you come to retirement. Now, the pension for everybody here is accessible, depending again on when you joined. But typically speaking, it's between the ages of 60 and 66 when the state pension is paid. Now, if you want to retire early, that's something that you can look at doing, but it will obviously be determined by the type of scheme that you're on. So again, it's best to speak to the advisor about what your options are. But the pension normal retirement age for anyone that joined before 1995 will be age 60. Anyone that joined after 2004, its normal retirement age is either 60, 65 or 66. So again, if you do want to have that option of retiring early, it's important that you look and see what your projected pension will be and what plan you need to make around it. Now, your lump sum as well, that again is depending on the service that you have, and that will be determined and accessible when you come to retirement. So that's the kind of the pension and the lump sum. So if we just maybe we'll go through and we'll have a look at an example, okay? As I mentioned previously, what determines your pension and lump sum is the type of PRSI or when you joined. So anyone that joined before 1995 will be on the D1, B1 or C1 class of PRSI, which means that they don't pay for a state pension and their pension entirely comes from their employer, okay? In most cases, some people might have some previous stamps, but the vast majority of the cases is their full pension entitlement will come from their employer. They're not entitled to a state pension. Is that okay? Post-95, so post-1995, everyone would be on the A1 PRSI. So what that means for everybody here is that they're entitled to a contributory state pension, okay? So they're entitled to a contributory state pension, but it is integrated into their pension that they receive from their employer. So I know some people here are thinking, well, God, people on D1 I'm only getting one pension and people after 95 are getting 2, but they're integrated together. So they're not in any better case of a scenario for those. And then post 2004, they again will be entitled to a state pension, but their normal retirement age is 65. And post 13, their normal retirement age, they pay for the state pension, but is linked to the contributory state pension. So which is kind of frozen at the moment at 66. But again, that's something that is open to review and can change in the future. So that's important for any entrant post 2013, something to really give consideration to. So if we look at this option, okay, so in 99% of cases, this will apply to everybody here that joined before 2013. The way that it will work is that on retirement, in the event that this individual had a full service and had a final salary of 50,000 and had full 40 years of service, they will get a lump sum of 1.5 times the final salary. Okay, very straightforward. Anyone that joined after 2013, they will receive and retires at their normal retirement age 1.5 times of their average salary in effect. Okay, so what that means is it's pre-2013, it's whatever the salary they finish on. Post-2013, it's pretty much an average of the salaries over a course of career. So there will be a difference there. But again, 75,000, 1.5 times. If you have half service, so if you had job shared for 40 years and you have 20 years of service, that means you receive 50% of a lump sum. Is that okay? So it's relatively speaking quite straightforward. And there is options that you have to try and, I suppose, alleviate that shortfall. And that's something we'll talk about as we move through in the presentation. So that's the lump sum, okay? The lump sum is accessible then for anybody who joined before 1995 from age 60, and then anyone who joined from to post 1995 to 2004 is 60 as well. Then post 2004 is aged 65 or 66, depending if you're on the newer scheme. But again, that's something that when you go through a review, you can look at in more detail. So the next is the pension. So this is what everybody wants to know, okay? So if we take a public servant, right, who's retired with an earning salary of 50,000 at retirement and has full service, okay? This is the pre-95 example here. So what we'll have here is this is the pre-95 example here, okay? So their full entitlement, they're entitled to 50% of their final salary as a pension, okay? Which is pretty clear, okay? So they'll receive 25,000 with full service. If it was a case that they had only done 20 years of service, they would receive 12,500. So it's pro rata reduced depending on the years of service that you have. If you want to retire early, you may have less service. So these are all things to consider. Then this example here is the A1. So the A1 stamp is for anybody who joined after April 1995, and they'll receive 13,217 from their employer as a pension with the same service as their compatriot on the pre-95. Now, maybe everyone have a think about why that case might be. And I think everybody knows that it's because of the state contributory pension. So the people who joined after April 95 will have an entitlement to a contributory state pension, and that will in effect bring them up to the equivalent 25,000. So they receive a pension from their employer, but they also receive the contributory state pension, which brings them up to that. Now, there's a couple of things that will impact on you in that. Number one, if you retire before your normal retirement age or your preserved retirement age, will that be state pension? Is there a shortfall there? And then especially for people post 2013, if you retire before that, is there going to be an issue or a shortfall between when you want to retire and when you maybe financially are going to be able to retire? And I suppose the point of the presentation is to get people to understand the difference on how the schemes work, but also things to consider when you're putting in place your financial plan. Is the pension that you're going to have going to be able to achieve the objectives that you want to have or to have the retirement that you want to see happen? Is, for example, your pension going to be the sole pension in the household? Will you still have dependents or in education, full-time education when you're in retirement? All these things are things to consider when you're looking and forward planning towards your retirement. So I'll remove these, or there will be on the next slide, which won't make a huge amount of sense. So, and what we'll move through then is onto our post-2013 scheme. So as I mentioned about the post-2013 scheme, okay, it's ineffectively a career averaged scheme. So instead of being based on your final salary, it takes into account all of your salaries over your working career. So as a result of that, that can obviously have a negative impact on what the final pension you're going to look like. So when it comes to putting in place a plan, it's important to take that into consideration. Also, your normal retirement age can increase. So it can change in line with the state contributory pension. So it's something to consider when you're looking at your retirement and when you want to retire. Is your when your desired retirement age in line with when the state contributory pension age, which is frozen at 66 at the moment, but isn't open for review. And it was, before this change came in, set at being at 68. So it's something to consider whether or not that's, is that the retirement you want to have, staying working till 68, or do you feel you want to give yourself the opportunity to be able to retire that bit earlier? So when do you get your CSP? So again, these are all open to change. So they were set at 60, 66, 67, 68. So it was 66 for the born before. It was 65 born before 1955, and then between 55 and 61 was 66, 67, and 68. But that has been since frozen, so there is a bit of ambiguity at that at the moment. So moving on. So things to consider, okay, and what can cause. One of the main queries that we will get is impacts on what my final service will be. And things that an impact on your final service are you started working later, you maybe had training years, or that you worked maybe in the UK or Australia and places like that. You want to retire early, that's obviously going to give you a shortfall in your service. Working abroad, as I mentioned, in the UK. And then job sharing or reduced hours. So you maybe had to reduce hours, you were working a different working pattern. And then career breaks. So you maybe took some time out to travel. They're all things that can impact on your service, which can impact then on the final side of your pension. And then non-pensionable employment. So if it was a case then that it was not considered reckonable service, that's mostly for people that, again, had joined maybe in the 80s and things like that. So look, we've talked a lot about how the pension scheme works, okay? Now, there is some other benefits that I'll just touch on. So as I said, there would be sick pay payable in the event that you were to get sick. So you will get the 3 months full pay, 3 months half pay. But then there will be a debt and service benefit as well. So if you're to pass away in service, there will be a lump sum. They might be fine, but again, it's all about exploring what they are, what benefits you have, and weighing them against what your needs and objectives are currently, okay? Now, when it comes to your pension, you will have options, okay, for when you come to retirement or prior to retirement. It's a bit late then at retirement. So prior to retirement, to make sure that, I suppose, your pension you're going to have is going to meet the needs that you have. So you can purchase back temporary and training years. So this is quite applicable for people that were maybe in the nursing profession, that were working and not paying into the pension while they were training. You can request an option to purchase your years back from that period of time, and it oftentimes makes sense to do so. You can purchase notional years of service. So what does that mean? So what that means is essentially purchasing additional years in your pension scheme. That's something that's provided through your employer and is something that you can explore and look at. Depending on the scheme that you're in will determine how much that will cost. But oftentimes when you look at the value versus what the return will be, you need to make sure that you get good financial advice on that, because sometimes it can work out to be very expensive. I know I have a lot of clients that have looked at it, and when they actually looked at the return from what they put into it to what they get back out of it again, they often felt that maybe there's other options that would be more suitable to them based on where they're currently at and what their current needs or requirements are. Because with the purchase in years, you're not buying just the pension back. This is on the pre-2013. You're not just purchasing the years back for the pension and the lump sum, you're purchasing the whole lot. So it's not an a la carte menu necessarily. You have to purchase the full amount. So you'll be purchasing back your debt and service, your spouse and children scheme, which may not be of any use to you. So it's making sure that you understand what the best course of action is. Okay, so the purchase of additional voluntary contributions, or AVC'S. So the AVC scheme is a means for people who won't have full service, or who are going to have want to retire early, or just want to give themselves more of an income in retirement. Their pension is going to be the sole pension in the household and they want to bump it up. Or people that want to try and make a better return for their money through tax relief and obviously growth as well. As we know, currently with inflation, money sitting on deposit is eroding away. I think most recent is about 6.5%. So if you're saving in the short term for your retirement in the credit union, it may not be the most suitable place for you. And then the last option when it comes to your retirement, to put in a financial plan in place, is the it'll be grand option. So I'll do nothing. So it is an option. You can do nothing. And again, it might be the right thing to do nothing. If it's not broke, don't fix it. But you won't know until you sit down and you have a look and understand what your circumstances are, and then build a plan around it. So how do AVCs work? So we administer one of the group AVC schemes in the hospital there and right across the public sector as well. So it's paid through your salary, which means you get your tax relief at source. And then you can add regular contributions, or you can add lump sum payments. So what that means is you can have your payroll deduction going through your payslip, and then at the end of the year, you can make a lump sum contribution if you wish. So this is quite applicable to people that maybe have other sources of income that are taxable, like rental income. They might want to offset some money into their pension to be able to reduce that tax bill. It's quite a handy thing to do. Investment funds, so it is invested. So depending on the time you have to go to retirement will depend on the level of risk that you'll take. So if you're closer to retirement, you'll naturally take less risk, but the further you are from retirement, you'll be taking more risk to give your money an opportunity to grow, offset inflation. But again, you'll be working on something that's going in with the tax benefit on the ceiling of it. And then with any plan or policy, there is charges associated with the plan. They're built into the contribution that you make, and they typically are an allocation rate and a fund management charge. Depending on how much you put into the plan, how far you are from retirement, and what it is that you want to achieve will determine how much in year one and how much you'll be paying in the charge, depending on your time to retirement. But they'll all be covered with you if you're looking to set up an ABC as a means to improve your pension for retirement. Okay. Now, if we look at the tax relief side of it, okay. So if you look at an ABC and you look at the contribution that you can put into an ABC. So if we take an example here of a client who sets up an ABC and they say, I want to set up, Neil, I want to put €100 a week or a month away. So that €100 they put away will attract €67 in tax relief on the higher rate. Okay. So that means for your net contribution to an ABC, you're saving €167 into your pension. Okay. So if you take a look and see what you'll get for your money sitting on deposit, like I said to you, if you're looking and saving that money for the long term for your retirement, it is in the wrong place because there's no tax relief. I think the best return you'll get at interest maybe is in a credit union at 0.25%. So the credit union is really around your short-term needs, like for example, if the boiler breaks or you're going on your holidays and things like that. Your longer term is your pension. So you get your tax relief and you get your growth. Whereas your medium term is around your savings and investment plans that we would obviously look at you as well. So there's a particular pot for each objective, and it's making sure that I suppose you don't overweigh your contributions in any of those and align them correctly to what your needs and objectives are at any particular time. Okay. Now with the ABC contributions, you're restricted on what you can put into an ABC by two people. They are revenue and yourself. So revenue will determine how much you can put away based on your salary and your age. And then you're the person that decides how much you want to put away, depending on what your objectives are. So what your plan is. We would always implore people to have a plan and have an objective and engage in your annual reviews and work towards a goal. Number two, when you put your money into your AVCs, you can't access it till you come to retirement. So it acts as informal wealth creation. So you're putting money into something that you can't access, but is growing and working for you in the background. Okay. So that's a brief overview of how the AVC works. And then your options at retirement. So how does the AVCs work in retirement then? Okay, so it's all well and good when I'm actually working and saving this money, but on the far side. So this will be important for people that maybe have an AVC from a previous employment, a past pension from a previous employment. These are all relatively quite applicable. So number one is to take your max tax-free lump sum. So if, for example, you won't have full service, you potentially can take a portion of your AVC out to dovetail up and increase your main scheme lump sum. So the AVC, as I said, dovetail into your main scheme and fill the shortfalls. So the first will be to look at your lump sum if you don't have full service. Step two, you have options with the balance. So you can either purchase an annuity, which is a pension for life. So you'll exchange the capital value of your AVC for a set amount every year. Okay, that's your first option. Number two is the approved retirement fund option. So this is one of the more popular options at the moment because people will have their set income from their employer's pension, and what they'll find is they'll be using their AVCs either to bridge shortfalls when they need it, like I said, if they still have commitments to mortgage or they want to do travel when they're younger. In retirement, that might be why they choose the approved retirement fund option. And then the option three is to take a taxable lump sum. So they may want to take an amount out when they retire initially to cover expenses and then choose between option one or two at the balance. Typically speaking, 99% of the time, currently people will look at the approved retirement option, but an advisor would always go through all three of those with you and make sure you're aligned to what suits you the best. Okay. So that's on the AVCs and retirement planning. What I want to talk to you a bit about now is what the other areas that we cover in a consultation, because it's not just about the pension. So the other areas that we cover during the consultation is we will review any other past pensions that you may have. So if you've maybe worked in private industry, you're just coming in here and you had a pension from a previous employer, you're not sure where it is, how it's being managed, that's when we would be able to review that with you, because you may be able to access some of it now. So you may actually have needs and requirements, some of that pension now that you can take a lump sum from to be able to pay for college fees, education costs, new kitchen, a new car, depending on what your needs are. But again, we would implore people to look at the options, because it's really important to know where that money is and what it's doing for you. This is a really important one. So from family protection planning. So what we will do with clients is we'll sit down and take a look and see what their main scheme benefits would provide in the event that they were to get sick or to pass away. Look and see with their spouse or their partner what they would receive from their employer if they were to get sick or pass away. And what you'll oftentimes find is that the member in the public sector might be quite well covered, but their partner or spouse may not have any benefits. So in the event that they were to pass away, it could put the member of the public sector in a precarious scenario. So it's about weighing up what your needs and requirements are and what the level of risk is at the moment to you if you're to pass away, and aligning a plan correctly to that. So for example, that includes the likes of life cover, but also income protection. Now, income protection, how that works is that it provides an income in the event that you're unable to work due to an accident, illness, or injury. So depending on what your current circumstances are, may require one or both of you to look at income protection in the household and put something in place to make sure you can meet the financial requirements that are there if you were to get sick. Savings and investment advice. So again, I touched on this previously. We have a lot of our clients now that are coming to us and speaking to us about what to do with the money that they've maybe saved over the last number of years, if they have, or the money that they're saving on a regular basis. Like, for example, the children's allowance. They might be saving for their college education of their children and saving in an account that is making little to nothing by way of interest. And they're seeing the cost of everything increasing at a rate of 6% at the moment every year. So they're saying to themselves, I'm putting money away for something now that's probably going to cost a hell of a lot more than it did today in 18 years' time. So you can look and see, is there plans or policies you can put in place to try and help stifle off that, but are fitted to your objectives. So it might be 5 years, 10 years, depending on what your current circumstances are. You can do that through regular premiums or lump sums. But again, if it is something that you want to discuss, our advisor will go through that with you. Existing policy reviews. So if you have an existing pension, if you have existing life cover, if you have existing savings or investment, get in touch with us, and when we go through the review, we'll see whether or not it makes sense to look at that. Again, like we say, if it's not broke, don't fix it. But we want to see, well, look, what your objective is, what's your plan, and do those policies that you have meet or help you get to that plan? And if not, well, why are we doing them? And that's kind of the areas. Now, as a company, we also have a mortgage broker in-house. So if anybody here is currently hearing what's on the news, which is the interest rates on mortgages are going to increase, and you're on a variable rate, I'd implore you to maybe look or speak with our mortgage team about maybe looking at fixed options, because that will be coming down the tracks. Or if you're in a fixed and you want to maybe look at a switcher, that's something. Or if you're a new applicant and going through that stages of looking, I need 6 months back statements, ID, and all the rest of it, by all means, speak to us, because Keane is our mortgage broker and he makes things very easy to understand. And then we do retirement planning seminars, and then we do have a retirement help desk. So we have a huge amount of resources that go into our retirement planning. So look, what's next? So I suppose from the the presentation here today, we'll be in touch with everybody to offer you a one-to-one consultation. And what the one-to-one consultation will hope to do is to give you a better understanding of your current circumstances and understand from speaking with you what objectives you'd like to see happen in retirement and what type of retirement you'd like to have when it comes to that. And we'll do a consultation with you by phone. We'll establish your goals and objectives. And from that, if the pension is fine and it's not broke, don't fix it. Excellent. But there may be other areas, like I spoke about, that you want to discuss, like, for example, what to do with some savings, like your old pension or life cover, etc. And then we'll evaluate that and come up with a solution or a recommendation. And then if it makes sense, we'll obviously show you what the charges are included in that. We'll show you what the policy plan provides on retirement, or in the event that anything was to happen to you. And then we go through the digital application process. And then one of the most important parts of the whole thing is your annual reviews. So some people here today may be an existing client of ours and may have an AVC, and it's really important. And the people who get the most from any plan is the ones that review it on a regular basis. And you may find that there actually is other areas in the financial planning process that you didn't maybe look at the last time you had a review. You may have moved house, you may have had a new addition to the family, work circumstances have changed. So it's important to review it on a regular basis, because it's not just all about the pension. The pension, your employer's pension provides the debt and service, the sick pay, but are they sufficient, or do you need to look at other areas like savings and investments? So, excuse me. So what happens next? So as I mentioned to everybody, we will be in touch with everyone on an individual basis to offer the one-to-one consultation. Okay. But what I would say to you is we will be finding that we're going to book up very quickly. So if you do have any pending immediate concerns, or you want to have a look and talk about any particular area that we covered today, I would implore you just to maybe go on to either the landing page that's available through the internet there and register for a one-to-one consultation, or drop us an email at beaumont@ipf.ie. So I did a very whistle stop. I didn't think I'd get through all of that, but I'm only 6 minutes over time, but we did kick off a little bit later. So, but look, I don't think there's anything else that I want to add for the moment. But again, as I said to you, myself, Keith and Molly would be in touch with everyone individually to offer you the consultation. But if you would like to touch base with us sooner, please let us know. Or if you anything I wasn't very clear about in the presentation, which I'm sure there probably was, feel free to get in touch.